All right, 2 weeks ago, I posted a $226,000 portfolio update. The market dropped hard this past week and has stayed down. And instead of buying the dip like everyone online keeps yelling, I'm actually doing nothing. And I want to explain why. Because this decision is way more important than it actually sounds. Quick disclaimer though, before we get into it, this video, as always, is for educational purposes only. This is not financial advice. I'm just sharing what I'm personally doing with my own money and my own accounts. Don't copy it or anything like that. This is strictly here for entertainment for you guys. Let's look at the numbers first, okay? 2 weeks ago, my portfolio was at $226,000. As of today, it's just under $228,000, about 227,959 to be exact. That might not sound dramatic, but it happened during a pretty ugly market week. Tech was way down, growth was down, sentiment was terrible, honestly, and yet my portfolio barely moved. And I was contributing some money into it. And now here's the part that most people won't show you, right? Over the last 7 days, my portfolio actually underperformed the S&P 500 by about $7,000. And typically I outperform the S&P like pretty routinely. My portfolio was down roughly $8,700. The S&P was down about $1,700. And I'm not hiding that because transparency matters. And I've told you guys since day one on this channel, I'm going to show you the good, the bad, and the ugly. Now, short-term underperformance doesn't mean that the strategy I'm using is broken. It often means that I'm positioned differently for risk. Most of the weakness came from the exact places that you would expect. Semiconductors, QQQ, tech-heavy growth funds, all the stuff that I absolutely love and invest in. Meanwhile, broader market exposure like VTI barely moved at all. This diversification is doing its job. And when growth runs, it runs hard. When growth pulls back, it's going to pull back fast. And I've said that on my channel here before that I'm going to feel it when tech is not doing well. That's the price of higher upside. And I'm okay with that. Now, here's where I'm going against the internet. I'm not buying the dip. Not because I'm bearish, not because I think the market is crashing, because I don't think that, not because I'm scared, because I'm definitely not. I'm not buying the dip because risk management matters more than aggression to me right now. I'm already heavily invested. I already have a couple $100,000 into a portfolio. I already have some exposure, and I'm also using margin like I've showed you guys in my videos. When leverage is involved, your decisions need to be tighter, not louder. And here's something a lot of people don't talk about enough. Paying down margin is a guaranteed return equal to the interest rate that's on that margin. If your margin rate is high, paying it down is one of the lowest risk, smartest moves that you can make, especially during a volatile week like this, which my margin at Schwab is like 10% or 11%. Instead of chasing upside during uncertainty, I'm choosing lower leverage, less downside risk, and more breathing room. This might not be exciting content, but boring decisions compound, and I'm showing you guys the realities of market downturns and using margin. So instead of panic buying or panic selling, here's my plan. I'm going to hold my current positions. I'm not going to sell them. I'm going to let volatility play out, and I'm going to consistently pay down my margin with all of my normal contributions, and I will reduce my risk while staying invested. I don't need hero weeks. I need consistency and survival. I'm curious, during this market drop though, did you buy the dip? Did you hold? Did you sell something because you got nervous? Drop it in the comments and let me know. I want to see how everybody handled this week because it's going to be different for everybody. And I'm not using all of my contributions to go ahead and pay down margins. So the way that I'm like actually structuring this is typically instead of investing $6,000 to $8,000 a month like I do, and I put that all into broad ETFs, with this I'm going to take 75% of those contributions now, and those are going to go to paying down margin. I will still take a small 25% of my contributions, and I will buy safer things like VTI, or ETFs like that. So I can still get some things at discounts, things that are less risky. I can still keep my portfolio moving a bit while I ride it out. And I'm going to pay down that, I think it was like 13,000 in margin that I have sitting on the account right now, which when this account bounces back up and the market stabilizes a little bit, I should see some significant gains for the recovery. And now my margin will be a lot lower. Hopefully that explained it to you guys. This is the stuff that nobody shows you here on YouTube. I'm showing it to you guys. I'm being real and transparent with my numbers. I'm showing you guys the ups and the downs. I've showed you guys nothing but ups so far in the last 2 months on this channel. So this is the first time I'm showing you guys a bad week, and this is normal. And I want you guys to see it and understand it and not be scared of it.